everyone. I hope you're really well. I'm Pamela Hastings and welcome you to another Barometer webcast. During this webcast, we will provide a review of current market and economic conditions. As always, I encourage questions from participants via the chat, or please email me at phastings@barometercapital.ca. We will address your questions at the end of our webcast. With that, I turn the conversation over to David Burrows. Hi, David.
Hey, Pam. Doing that. Everybody, thanks for taking the time today. It's probably a good day to be doing an update. Market's been bouncing around a bit today, and so I thought I'd sort of take things from the top. We'll keep it sort of high level. You know, just as a really quick reminder, we think that there's three core pieces to drive return on a portfolio. One is get the asset class right. Where should we be exposed? What should we be avoiding? In the asset classes, drill down to sectoral themes, try to find structural themes in the market that are being revalued positively and focus in those areas. We sure don't have to be in every sector or every theme. And then third, we use our bottom-up tools and screening process to try to find securities within those leading themes that have characteristics that point to something getting better. And I had an interview this morning on BNN, and one of the questions they had for me was, what should people be careful of right now? And my comment was, I think that people need to be careful of the dash for trash. Over the last couple of weeks, a lot of money, especially private client money, has chased into the most beaten down stocks in the most beaten down sectors with the expectation that they will be the next thing to go. And as we've talked over the last few weeks, we talk about trying to find sustainable leadership. We really like to focus on good getting better because it means you're not dependent on the economic environment improving for them to succeed. And we always are interested to see what happens in a pullback because it tells you just how solid the support is for various themes or how ephemeral. And so from the top, we've talked about the fact that the US stock market, this is US stocks back to the 1980s, is in a structural bull market. We went through a structural bear market from 2000 through 2013. We emerged from that and the market has marched its way higher since then with various interruptions, but holding this long-term trend. And we came right down and kissed it and just dropped below it briefly in March of this year, quickly reversed up. And here we are on this chart looking like we're very close to the highs. A week ago when we did our call, we talked about what we were finding from the internal work that we do on the market to understand market health. And we talked about the fact that we were seeing sort of improvement across markets. This is from 2 weeks ago, where breadth was expanding in the NYSE, meaning the percentage of stocks in uptrends was expanding. Globally, the percent of stocks in uptrends was also expanding. And in Canada, we were seeing that. We did talk about the fact, though, that our short-term indicators, the percent of stocks trading above their short-term moving averages and longer-term moving averages and percent of stocks with positive momentum were really quite stretched. And historically, that tends to point to the fact that there's some risk of some correction. Last week, we highlighted that the percent of stocks in uptrends had started to reverse, and we had started to see some weaklings sell off. And as we sit today, you can see it's a different looking picture. Percent of stocks in uptrends in the NYSE has started to decline, meaning so we're marked that in red to show that that's a red mark or that's a warning sign. Global breadth has started to deteriorate. And all these arrows you can see are pointed downward, meaning that in each of these indicators, things have started to weaken. So that tells us to be a little bit more cautious. It tells us that despite what our opinions may be, the sum total of the news is not strong enough to continue to push things higher, and that there is risk that if the weaker securities sell off, it can wash into the stronger securities. So NYSE breadth as of last week had moved down from 80% of stocks in uptrends to 68. As of this morning, it was sitting at 66. And through the course of today, there were actually almost 900 sell signals across US markets. And this has moved this percentage down to closer to 60%. So about 8% of US stocks today reversed lower. And again, that's cause for concern. Now, as you know, we use stop losses on our positions. And I can say actually very few of our positions broke down technically today, but we take note of the fact that some of the weaklings are reversing down. Now, when that happens, when we see these reversals, we get a little more cautious. So I said that some of our portfolios were more aggressively positioned. In those portfolios, we've put some S&P 500 hedges in the portfolio to reduce volatility, or in effect, to give us the effect like we hold some cash. And we do have some small cash amounts. We said that one of our portfolios, the global macro portfolio, had been structured recently much more defensively because it's a long short portfolio. And we came in today pretty much fully hedged, in fact, a little bit short the market. And so that had a decent day. When we look at the market as a whole, this is the decline and the recovery. We had the first phase, which was a technical bounce off the bottom, a little pullback. Then we had the next phase of bounce that came from fiscal and monetary stimulus policy stances. Then the market consolidated for a few weeks. And then we had another move when the COVID numbers started to come down and we started to look forward to reopening. And through the piece, not all sectors behave the same, some better, some worse. But then over the last 12 days, you can see the market has been consolidating. A little down day today. If we take a look at it another way, you can see that market pulled back off the highs. As of last week was about 5% from the highs, and as of today is about 9.5% off the highs. So it's pulled back about 5%. Now, the big factor I think that drove the rally was liquidity. We put this chart up last week. In red is global liquidity growth. That's monetary and fiscal stimulus. And you can see that it's been massive over the last few months. The old saying, don't fight the Fed, has been in play. And so asset prices have been rising. The last time we saw this much stimulus pushed in was the Plaza Accord in 1984, which kicked off the bull market of the 80s. So you don't yawn at that. That's a very significant increase in liquidity. And a lot of it finds its way into financial asset prices. And we certainly have seen the beginning to that. And you know, interestingly, sentiment surrounding central banks has been markedly improving as they've gone through this process. They've been very effective. This is sentiment toward the Fed, Powell, QE, and stimulus actually turned positive for the first time in several years. We know that the market's been fighting a battle. You've got fiscal and monetary stimulus on one side and expectations for weak earnings on the other. And there's been a chasm that's opened up between these two that will get filled probably by both of them moving toward one another. Eventually, we're going to see earnings start to improve, and we're seeing some groups have earnings revisions higher. And we may have the market pull back a little bit, or certain groups pull back. But ultimately, you know, the stimulus feeds into this. We've seen weekly unemployment claims start to come down. That's a positive, but they're still quite elevated. And we know the history is when you have recessions, you know, it takes a while for employment to come back. So we've had a nice bounce, but we're still very early days there. And of course, in the last 10 days, we've seen a reversal or a pickup in the COVID cases in very specific states, most of them where they reopened quickly. And that's certainly on investors' minds. You know, the airlines have had a rough few days as there have been new restrictions put on travel and on quarantine between states. You know, there are some bumps taking place, and we thought that might happen. So we've always known that this COVID-19 risk is out there. We know the economic risks. I think this week we saw a couple things raise their heads a little bit more. Certainly election risk that the Republicans lose the White House. Some would think that that's not such a bad thing. Some would think it is a bad thing, but it probably would mean more taxes. It probably would mean slightly less business-friendly policies. And also there's been some specter of trade risk between certainly the US and Europe, and there was some saber rattling between US and China. All of these things go into the mix, and they are offset by liquidity, still quite defensive positioning by professional investors, and still quite skeptical sentiment on behalf of professional investors. So the reality is that all these things go into the mix and price behavior comes out, and that's why we track breadth, because the market's a big machine and price is the output. And so we like to track whether more and more companies are performing well or fewer and fewer, and where we're seeing strength and where we're seeing weakness to help us manage our exposures. A few other things that have come up this week: insolvencies picked up. That's bound to happen. I think that's not a surprise. And so let's look at what the market can tell us. First of all, S&P is about 5% off its highs, most recent highs. I think what's interesting about this is when we pull this apart a little bit, if we were to look at the same 500 companies and weight them equally, you'd see that the equal weighted S&P 500 is down 11.6% in the last 2 weeks. That's why we want to know what's happening under the surface. The biggest stocks can mask changes that are taking place, and certainly Apple and Amazon have had a tremendous 2 weeks, as has Netflix and some of the other large cap growth stocks. That has held the S&P higher, and certainly the NASDAQ higher, opened today at a new high, down a little bit on the day, but the average stock certainly down more. So where's the strength? The strength continues to be, even with weakness over the last 12 days, in technology. Large cap technology opened today. These are weekly charts at new highs. Group backed off, about 0.5% today, a little bit more certain groups, but technology, relative outperformer, was relative outperformance through the rally leading into February, and an outperformer since then. So again, we see weakness in the market. What is it that holds up? What is it that gives back the gains? What is it where are the real buyers? Where is their short covering? Technology was a leader between January and February. It was a leader from February through March through the decline. It was a leader since the bottom. This has been a constant. This is really where our largest weights remain. Biotech and healthcare. After a little pullback for a couple of weeks, biotech took off again, new highs. This is really as of today. Relative price performance has continued to improve. Very clear upward bias. Consumer discretionary making new relative strength highs. And this includes all kinds of groups, including some of the travel companies that have been weak. So there's obviously some real strength in here. Some of the branded companies we talked about last week, like Nike and Lulu. Certainly the internet retail companies like Amazon. This is really remarkable. What a great rally this e-commerce group has had off the market lows. FinTech has had a wonderful reversal, also part of the technology group. And golds, as we talked about, have continued to power higher. We set a new high this morning, and both gold and gold stocks have performed really, really well. So these have been core groups for us. Also, we talked about over the last couple of weeks, China's further ahead in the reopening. They've certainly done a great job in sort of cornering this virus. They had a little flare up in Beijing, which has been put down, it seems, quite quickly. That's Chinese technology and Chinese consumer group performing well. So there's lots to do in these groups. And we certainly want to see how they do in a pullback. But so far, given the pullback today, held in quite well. Now let's look at the groups that are reopening sectors, ones that are more risk attached to the reopening, and see how they're doing. So certainly we had a good move in the banks over the last 3-4 weeks, but in the last 2 weeks, quite significant pullback. Banks were down about 5% today. So was it short covering? Was it real buying? Was it optimism? Well, it could be all of those things, but when the risk picks up, these back off. So I think we told you that we had added some banks. We have been scaling our way back out of banks over the last week or so, just because on a relative basis, they've not been able to hold up in price. Industrials, very similar picture, very different than technology and healthcare. Transportation, underperforming. And certainly energy, after a bounce, having quite a good sized pullback, the energy sector down about 8% today. So we had small toeholds in these groups. Most of them we reduced over the course of this week. We'd like to see them follow through. It speaks to the fact that we're in a market where we need to be targeted. We need to be in good getting better, not broken getting fixed. The concept of owning something that you hope will do well if economic conditions do what you hope they'll do is a riskier bet. And I think the market is not quite ready to put a lot of weight into these groups. Utilities have been relatively underperforming. This has been a group that we reduced over the last 2 months, and telecom relatively underperforming. So there are some themes within this market that are structurally benefiting from what's taking place in the world. Some business models that are being accelerated, like in cloud-based computing and cybersecurity, internet retail. These are groups that are seeing increases in earnings estimates, increases in ratings, and certainly have broad followings. And then there are others that are relatively underperforming, either because there's concern about the various risks in the economy, or because they were overowned coming in. And we talked about last week how the groups that act like bonds have been quite overowned, and they do have some structural issues. So things that give us reason not to believe that we have big risk right now. Certainly, the positioning in the market by professionals continues to be quite cautious. As of the end of last week, there was the largest net short positioning in the S&P 500 going back to 2011. So what that means is, as markets pull back, short sellers will have to cover at some point. It creates natural buying in the market. We know that the active hedge funds still have relatively low positioning relative to history. So relative to where they were in February of this year, where they were in September, October 2018 was much more significant, which means they can be a net buyer on any pullback in the market as well. So we're going to watch those. So S&P is pulling back. It's a natural correction. Right now we're sitting right along sort of long-term moving averages. My guess is we probably have several days, if not 2-3 weeks of choppiness in the market. We're going to continue to monitor the stops that we have on our individual portfolios and individual positions. As I mentioned, we do have some hedge in the portfolio. Pullbacks are completely natural and should take place. NASDAQ, the home of technology, much stronger than the S&P. We have more exposure here. We'll watch to see that these continue to hold up as well. If things get worse, we'll continue to get more cautious. So we're long-term bullish, short-term a little bit cautious. We are set up for that. We've been through lots of corrections, and we're very willing to play defense. We're certainly a little more defensive today than we were a week ago or 2 weeks ago. I'm really pleased with, in general, how things have gone. The long-short portfolio, I think this morning, was up about 20% on the year. The equity portfolio, about 11% on the year, way ahead of markets. Balanced portfolio, I think, is down about 5%. Macro portfolios trailed that because it's been more defensive, but should be able to pick up through the correction. So certainly happy to answer any questions, but as always, this is about step-by-step, adjusting portfolios, making sure we're monitoring, making sure we're following the process that we sell, and not getting emotional. So Pam, if there's any questions, certainly happy to answer them.
Great. We have one question. Thank you so much, David. Any perspective on the Canadian dollar versus the US dollar going forward?
Yeah, that's a great question. If the economy is going to continue to improve, the Canadian market is a little more cyclical than the US economy is, a little bit more dependent on global growth, trades a little bit more like emerging market currencies. You would expect it to firm up. If your expectation is that the reopening is going to take longer, it could continue to back off. The Canadian dollar bounced from sort of 69 cents to 73 cents. In our portfolios, as it is, we are hedged back to Canadian dollars currently because we do think the longer term picture is brighter in general for the global economy coming out of this hole. But certainly it could move either way by a couple of cents without much difficulty. Having said that, we're taking currency currently out of the picture and focusing on the returns of the underlying securities.
Thanks so much, David. That concludes our questions for today. I know that next week we are going to take a pause on our webcast and we will resume because it's Canadian, the Canadian long weekend, of course, and then we will resume the following week with, I think, a topic on real estate.
Great. So thanks very much, everybody, for joining in. We'll send out the replay for those that missed it. And certainly don't hesitate to contact us, either your investment counselor or contact me directly. Certainly Greg's happy to jump on the phone if you've got any questions. And we certainly value you as clients and appreciate your trust. And please continue to tune in. If you want to follow between these webcasts, I do post some things on Twitter as things are taking place. At Barometer CA is the handle. Other than that, just pick up the phone and give us a call. Thanks so much.
Bye, everyone.